Hey guys, what's up? I want to show you in this video a strategy that can help you make a 94% return when trading dip buys. This is called the winning whale strategy. I'm going to explain the back test to show you that it works. I'm going to explain the theory behind it so you understand why it works. When you're trading it, you're like, oh yeah, this makes sense. And then I'm going to show you step by step how to place this trade. So step number one is what is the back test. You can see here with SPY, or the S&P 500 ETF, we have a 94% win rate with a 63% yearly return. Now again, this trade does not happen every single day or every single week. Maybe once or twice a year do we get a string of these trades. Now again, that's because it's a dip buy strategy. So that means the market needs to sell off in order for the strategy to happen. But I'll explain more about that in the step-by-step process. All right, so you can also trade this on DIA. If we go to DIA, you can see it has a 93% win rate, and you can also change it for other stocks as well. TLT will typically have more occurrences, but again, you can see here, but again, your win rate is a lot lower with that. Anyways, you can make the stock you want to trade on, but SPY and DIA tends to be the best stocks for this strategy. Okay, moving in with the winning whale strategy with a 63% yearly return, I'm going to explain the theory behind why this works. Also, quick side note, if you want access to the back test, you can become an Inner Circle member, or just leave a comment down below and I'll send you a CSV file of the entire backtest if you want it. Okay, so if we see here, the way that we structure this trade, or the way that this trade works, is what the winning whale is. So if you never heard of a whale in the market or in the trading game, a whale is somebody with a ton of money. It's typically a hedge fund, a bank, an institution, or something like that, which has enough money to move the market. It also could be insider traders like the CEO or the CFO who buys or sells a large portion of their company's stock because they know something. So this typically happens around lows. When the stock reaches a low, then you'll see the CFO of a company or a big institution buy a large portion, and then it'll trade up. And so that's what this winning whale strategy is. It's buying the dip, but also knowing how to buy it. So again, when you're trading put credit spreads, your whole goal is to make money on the upside, right? A put credit spread makes money as the stock goes up, as it stays the same, or goes down a little bit. And so when we're trading put credit spreads, we're looking for an opportunity for the stock to move higher. And with dip buys, that's the perfect opportunity. So that is the theory behind it and why this works. Now, to explain the strategy step by step, this is how it works. First off, we want to make sure that the stock is bouncing. That's what this criteria is right here. It says, is this stock bouncing? And so what it looks like is we're waiting for the stock to go below this bottom yellow line, which is 3.8 standard deviations below the 200-day moving average. Once it breaks below that and then breaks back above and closes above it after being below it, that is our dip buy entry, and that is what satisfies this as a dip buy. Because statistically, when that happens, the stock recovers shortly after. So that's what the setup is. Now we need to determine our short strike price for our put credit spread. So that's going to look like this. We're going to take the stock's current close price and multiply that by 96%. So let's say this was our entry right here, because you know this is where it closed back above. So if our entry is right here, then we're going to take let's see what the close was, 365.97. So 365.97 times 96%, which we can see here, 96%. So we're going to multiply that times 0.96, and that's where we're going to get our short strike. Now we're going to round that. It says 351.33. We're going to round that to the nearest whole number. So we're going to say 351. So our goal is to short the put contract at 351 strike and then buy the one right below it at 350. So that's how we're going to set up our put credit spread. Now again, this is an example way below where the stock currently is, so it's going to be hard to set that up on a real example. But before we do, we need to determine our expiration date. Our expiration date, again, this is the best expiration date based on the strategy being optimized a lot of different times, is 14 days. So what you do is you take the current date, which is currently March 31st, you add 14 days, so April 13th, and you round to the nearest Friday, which would be April 14th. So again, we're going to go and we're going to set up this trade. You can see here we go into Robinhood, we go to Trade SPY options, we go into Builder, we go into Put Credit Spread, because that's the spread we're trading. We're going to go into the expiration date that we determined. So it's going to be April 14th. just like that. Now again, we're probably not going to be able to find the exact strike prices of what we found because it's way lower than where the price currently is at the moment. So we would need to go all the way down to, what was it? 353? Yeah, 351. So yeah, it doesn't go down that low on here just because there's no value in it. But again, that's because we're not near that. We were just giving an example from way low. It's currently trading at 408. Anyways, that's the example of how you would set up the trade. Now, the next thing you need to know is that you want to collect at least 15 cents in credit. Now, what you do have going for your advantage that is not shown here is when you're trading like this, when the market is dipping down to new all-time lows or lows that it hasn't been to in roughly a year, then your IV rank is going to be very high. When your IV rank is high, you can collect more credit. So your goal is to collect 15 cents minimum, but you should be able to easily collect $20 to $25. You can see here the average, roughly $22 to $26 in credit, and that would be an amazing credit because the IV rank is very high. Anyways, that is the idea of buying the dip and using put credit spreads to profit from it. So if you're someone who wants to take advantage of this, make sure to click the link below to check out this article that lays it out step by step so that when a dip comes, you know how to profit from it. If you want these alerts sent straight to your phone via text, email, Discord, whatever, then check out the 10% Credit Spreads Inner Circle program where I share my personal trade alerts where I trade for a full-time job. That's what I do with credit spreads and other things like that. So if you want to learn more, smash the thumbs up button and smash the subscribe button because I have more strategy videos coming. I hope this makes sense and I hope this helps you profit using put credit spreads.